I think the sweet spot for the next 10 years, if I take a very structural view, is companies which can become big by exporting. So I am more positive on, pharma and engineering input value industries like capital goods or defense, specialty chem, IT products, contract research, pharma, stuff like that. I feel if management teams in these industries have the vision and can, instead of just catering to the domestic market, become global leaders, hopefully.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's episode, I'm thrilled to welcome for the very first time Manish Gunwani, Head Equity at Bandhan AMC. Manish, welcome to Paisa Vaisa. It's great to have you here. Thank you so much for
Pleasure being here.
Yeah, finally we have you here. So I want to actually, this is the first recording we've done after the recent tensions between India and Pakistan and the obvious impact that it's had on the market. Any thoughts of A, what happens next, and B, the impact on the market?
Sure. I guess
It's come out of nowhere, right?
I know.
When we started this year,
honestly, it's escalated way beyond what I thought will happen.
Yeah.
Unfortunately. So see, you can only take a probabilistic bet. I still think that there is too much at stake for both the countries to let this go further. The extreme part of that argument is nuclear deterrence, of course. So I think very high probability it should cool down from here. But I also think if you step back and see what it could mean structurally, because hopefully this will pass, I do think that the world is getting polarized a bit like Cold War pre-1990. And this potentially, no one knows for sure, can push India a bit more in the camp of US. Because clearly Pakistan is a bit closer to China. A lot of the weapons we all seen that. Bit disappointing that even Russia did not criticize Pakistan too much. So I think there is a possibility that this axis between China, Iran, North Korea, Russia versus US, Europe, Australia, India, Japan maybe. I think that polarization can increase, and maybe India will have to take a stronger side. I think India generally tries to be neutral. Yeah. So that's the slightly long-term thing I'm reading into all this.
You think the markets will eventually stabilize as the de-escalation happens?
Yeah, I think so. Because generally we've seen, even in Russia, Ukraine, Israel,
Hamas,
yeah, it doesn't really affect the economy. But yes, it is a bit of a surprise.
Geopolitics is always that kind of thing which you can't predict and have.
And what's also a bit surprising over last one and a half day is the size of the country which has got affected, right?
Yeah.
I mean, because if you think about it, Kargil was such a narrow sector.
Yeah.
But if you see over the last 24 to 36 hours, the engagement has gone from Gujarat to North Kashmir, which can potentially affect the economy at least for a few days, much more than historic frictions that have happened. Yeah. So yes, it is a bit more serious than some of the previous incidents, but I'm just hoping good sense will prevail.
I think, first tell us about yourself.
Yeah.
And tell us about Bandhan. Like, you've got this very interesting career in mutual funds and even on the sell side, like we were talking about. Just if you could tell us about that and about Bandhan.
First of all, nowadays you feel a bit old when you talk about this.
That's supposed to be a good thing, though.
Yeah. Hopefully sign of wisdom.
Yeah.
So I graduated out of management 1996. So you could look at it in two parts. 29 years, long time. 6 years in technology entrepreneurship across two stints, doing a software product, and in fact even before that doing some .coms in
which
2000.
Was the flavor of the at that point of time.
Did a Padai.com in 2000.
Oh, nice.
With dial-up connection and all
very
that.
Early you were on the scene.
Bit too early.
EdTech.
Now it's called EdTech. That we didn't know what it was called. Yeah. But yeah, 23 years, which is most of the career, being on the investment side. Initially, what we call sell side, like working in a brokerage, providing advice to clients. But last 14-15 years on fund management within mutual funds. 3 stints in mutual funds. one in ICICI Prudential as a fund manager, in Nippon, which was Reliance Mutual Fund, as CIO, and CIO in Bandhan AMC now.
Tell us about Bandhan.
So Bandhan actually an old firm. This avatar is a bit new, but the firm is quite old. It started as Stanchart Mutual Fund.
Oh, okay.
Then morphed into IDFC, which was the longest stint. So that brand is actually well known, especially in fixed income.
Yeah.
And then 2 years back, we got bought over by Bandhan Group, along with two very well known private equity funds, GIC, which is from Singapore, and Chris Cap from India. So you're 60% owned by the Bandhan Group, 20% each by these two private equity funds.
Okay, and your product portfolio?
We are as big as any of the top 10, 15 AMCs. On the equity side, there are typically 7-8 big categories, which is large cap, small cap, mid cap, and then you have thematic funds like financial services, business cycle, infrastructure. We have all of those. We probably, being a bit young, we have some product here which we'll launch in the next 1 or 2 years.
Just tell us how you find India's overall macro.
Yeah.
Looking at both internal demand, which is consumption capex, as well as external, the current account and currency. Let's start from there.
Sure.
One is top down, and if you could please add some specific trends that you find interesting.
See, the economy is always a complex animal, so there are always positives and negatives. So let me talk a bit about what I see are the big 2-3 positives and big 2-3 challenges as I see it. I think the biggest positive difference which I see in the economy over last, let's say, 5 years versus 20 years before that is our situation on current account, right? Because current account is basically total exports versus total imports. Luckily for us, post-COVID, our biggest export is services. And services, what has happened is, apart from doing IT services, which was the bulk of what we used to do, post-COVID, since remote working has become acceptable, we've seen these global captive centers mushroom in India, the GCCs, and they do a lot of different things, R&D, consulting, auditing, etc. So our services exports went from 80 billion to about 200 billion annualized now, big boon. And our biggest import is oil, which thankfully, given world is moving towards EVs and renewables, oil prices are quite benign.
Yeah.
I think not too many people probably realize this, but after 30-40 years, for the first time, India has become a zero current account deficit country virtually.
A huge achievement.
Yeah, it's
from 91,
it's almost like a big milestone. So it reports as 1%, but that includes gold. And I think given that services will probably grow faster than oil imports, I think we will report 0% in the next 3-4 years. I'm hopeful. So that is obviously something very, very big. And which is also a bit of my investment call that a rupee will perform much better in the next 10 years than in the last 20-30 years, which will drive foreign capital into India, which is why valuations will remain higher. So a lot of people feel a bit uncomfortable about our price to earning multiples today.
Premium to pretty
but
much
I do
everybody
think
else,
10-20% we will be higher, purely because if our currency is doing well, then the total return which foreigners get, obviously currency is a big part. So the cost of equity in one sense is coming down. That I think is a big positive. The other big positive, I think it's probably not pure macroeconomic, but just the positioning in terms of geopolitics that between these two blocks, which I talked about, we probably are one of the few countries which will have the size to engage with both sides. Although I think finally we'll have to lean towards one. But I think we can, first time in maybe our history, we have a chance at mass manufacturing, because China obviously not very acceptable to a big part of the developed world. And I think we have the people, we'll probably have the trade framework, because till now, not only China, I mean someone like Bangladesh was a big competitor in textiles, for example. I'm hoping that we can leverage our size, our positioning to get great trade deals. And if we can get mass manufacturing, we can finally resolve this inequality, which is such a big problem for us, that we have income inequality and we have regional inequality where North and
North
East
and
have
South,
struggled, right?
yeah.
So those, I think, are two big positive trends. Two challenges I see is a lot of people probably again don't see it from that perspective, but India's demographics is becoming a challenge in the sense that when you see us at a country level, our population is still growing a bit. Uh, but when you see on a GDP weighted kind of lens, that the South and West, which are more about 50% of GDP with 30% of population, their birth rates have started coming down materially. So I think their
any
birth,
matured,
just like a Europe or US in
Yeah.
one sense. In fact, I think states like Telangana and AP, the birth rate is similar to Sweden kind of places,
wow,
because
I didn't know
1.3,
that.
1.5,
Wow, okay.
right? And Tamil Nadu apparently will start degrowing in 5 years.
Okay.
So the thing is, we are kind of aging before becoming fully rich. Although this region is reasonably prosperous, but obviously nothing to the extent of Europe and US, which have $40,000-$50,000 per capita, right?
Yeah.
So I think that is a big challenge we have. The other thing also is like, while obviously on current account we're very good, but because historically we ran a deficit, I think we should also be a bit careful that on balance sheet we are a bit fragile in the sense that if you see the mark to market of all foreign equity investments, that's about 800, 900 billion.
Okay.
And our reserves are 650 odd. So our liabilities are still much more than our reserves. So in a way, the international investment position, as they call it, we are negative. Right?
Basically,
So
you're saying
whenever
that-
there's a risk off in the
Yeah,
world,
yeah.
so a lot of people think we can decouple. I'm a bit cagey about this because our balance sheet is still not great on the external
Wow.
side, right?
Usually, if I find mutual fund managers getting very excited about the domestic flow, saying that's going to offset.
So
and
I
I'll come to the flows part
yeah,
later.
but I get very nervous when people talk like that, that foreigners don't matter, and now
We don't have that luxury as
we
yet.
don't have.
Okay.
If your international investment position is very positive, then you can say that.
Yeah,
But we should be careful, and also again relating to geopolitics, that when you have to choose two sides among these two sides, we have to be careful that we owe a lot to one side. Which is the Western side.
Correct.
That these $900 billion are largely from Western world, and if they pull out in a short period of span, which we saw from October to March, in spite of domestic flows, you will not get a healthy market.
There's a shakeout in the
And
market.
also,
that's
more
happening.
than the stock market, I think I worry about currency volatility and foreign debt facing issues and stuff like that.
Yeah.
So I think we have to be very careful to not disregard this dynamic.
If I break this down into sectors, am I getting the idea that the domestic cyclicals and banks are something that you would prefer over the others, or is it something different?
No, not necessarily. In fact, I think the sweet spot for the next 10 years, if I take a very structural view, is companies which can become big by exporting.
Oh,
Because I'll
interesting.
tell you why. It's related a bit to valuation and market cap. See, what has happened in the last 30 years, the market has been dominated by domestic consumption driven. So private banks also are to a certain extent consumption driven. So the market caps of these sectors has gone up a lot, right? FMCG and private banks, etc. So they will do well because obviously if I'm positive on domestic macro, they will continue to compound a bit.
Yeah.
But a lot of the valuations factor that in. Where I think the big delta can come, and this might not be, although it will be sector driven, but maybe it has to be combined with some great management teams.
Sure.
But where I see big market cap change happening, where the addressable market is multiple times of what the market cap is today reflecting, is what I call this white collar workforce driven industries,
Very
basically where your
interesting,
graduates and postgraduates are working,
Huh.
with the idea being again that maybe first time we have the chance to become big in manufacturing, and low end manufacturing will get automated. So I am more positive on pharma and thoda engineering input wale industries like capital goods or defense, specialty chem, um, IT products,
Yeah.
contract research, pharma, stuff like that. Because if you see two, three big things for this segment, one is the Western world has aging demographics. If you see the healthcare costs in US, UK, there's clearly a problem, right? Whenever you talk to people there, they get frustrated at the quality of healthcare they're getting because the cost is very high.
Yeah.
So in a lot of these places, they are looking for outsourcing. They are looking for cheaper solutions, where I think India can fit in very well. Second is, again, people are wanting to disengage from China to a certain extent.
Sure.
And third is, I think India has the IPR taxation thing set courtesy the IT services boom.
Correct.
Right, which is why you're seeing this GCC boom, that our infrastructure, although it's not great, but the soft infrastructure in terms of culture, in terms of English speaking, in terms of the patent laws, etc., much reasonably good. I mean, nothing is perfect, but
Very interesting.
so I feel if management teams in these industries have the vision and can, instead of just catering to the domestic market, become global leaders, hopefully.
Pool isn't very big, right? I mean, if you look at the number of companies that are here in this, or
But if you
But
include small caps, there are a lot.
that's what I was just going to say.
Yeah, it's
that
not
you've got-
large cap.
So it's more of a management call and a bottom-up approach that would.
Honestly, I don't think you'll make too much money in large caps.
Okay.
Because if our demographics is picking out and if you're consumption driven and valuations are already expensive, I can't imagine making too much money in the current index large caps.
Okay.
I'm just hoping that some of the smaller and mid-sized firms, if they can use this macro, and we've seen some of it is outside our listed, but if you see Freshworks and Zohos of the world, they're multi-billion-dollar companies which have been created virtually in 5, 10, 15 years, right? And
Short period of time.
so I'm hoping that my stock picking is more in that direction.
Nice.
That see if you can find someone who can become big globally.
You think that in terms of supply of these ideas from companies that aren't listed as yet, you think that might increase in the next maybe 10 years?
Yeah.
More companies will come in and that will bring in more vibrancy.
Yeah, that's my other call, that what seems to be happening in the private markets in US and Europe is playing out in the listed markets in India. So if you see US listed market, number of companies don't increase. Actually, a lot of private equity takes companies and delists them.
Buybacks have gone up.
Buybacks, right? And the supply of equity is actually going down there.
Yeah.
But I think in India, I don't exactly know the reason why, but very small companies get listed relatively early, right? Let's say someone raising $100 million in more mature market, that should have happened in private space. But in India, it happens in listed, which is good for us stock pickers. So yeah, the choice is very vast. See, today, if I take cutoff at 2,000 crore market cap, below that, institutions like us find it difficult to invest. But reasonable growth, good management teams, 2,000 crore, I think there are 500 stocks maybe.
That's a nice pool to choose
That's
from.
a big pool to choose.
It's
And
like
even
10%
10
of all
them-
listed.
10 of them become big.
That's a good multiple.
And obviously,
to-
we'll invest in 100 and realize which were the 10s. I mean, a priori, we may not know which 10. But I think that's the interesting theme to look at.
So you spoke about current account, you spoke about currency. The last thing that I want from you on the macro front is interest rates. Where do you see them?
I'm actually a very big bull on duration in India. I think.
Nice. Interesting.
Again, no, it's not necessarily
Especially
a
since
positive.
you've got a very big debt book out there, debt mutual fund. But let's get your view on that.
No, it's not necessarily a very positive thing. See, one is demographics, right? That I feel growth is unlikely to accelerate, right? Because every country which is rich is degrowing in population. And these things can't be fixed overnight, right? I mean, there are many uncertain things in economics, but the closest thing to certainty is demographics, right? Because these are 20, 30-year trends. And even culturally, when I see the next generation, their ability to form long-term relationships is going down only, I think.
Our generation is done and dusted.
Right. So one is, if long-term demographics are pointing to aging population, less people working, I think demand in like we've seen with Japan,
Yeah.
we will have falling interest rate. And two, the positive side, as I said, that if I am confident that the currency will do well. So let's say if Indian 10-year yield is 6.5 and US is at 4, but I feel rupee will depreciate less than 2.5, then I'll be buying Indian 10-year yield and pushing it towards 6, right?
Correct.
So that way, and I have some personal investment in 30-year bonds,
Okay.
which are buy and hold. Like I've forgotten
Wow.
that that money is there
30 year.
because I feel maybe 5-10 years later you will see Indian 10-year at 5.
Yeah, but 30-year sovereign, you're saying. It
30-year
can't go wrong.
bonds.
Yeah. It's sovereign means there's no.
There's an MF product
Yeah,
which
yeah,
has
yeah,
those
yeah.
bonds. So I'm quite bullish that across cycles, I mean, we'll obviously see cycles.
Yeah, see, I'm trying to link that theme to the cost of equity, cost of capital for the smaller firms that you're talking about, smaller and mid cap. Because if what you're saying happens, then the cost of capital actually goes down.
Yeah.
That's one good fallout, I'm assuming, of interest rates going down longer term. And that's
Yeah.
good news for the small and mid cap
Yeah.
sector.
Yeah.
You think that's going to play out?
Definitely. I mean, definitely to the extent that one can predict, obviously. But look, energy costs unlikely to go up, right? Given EVs and renewables and all that. And then you have demographics. Then you have this inflation targeting framework, which we got 7-8 years back. Actually, the fruits of that now are playing out.
Yeah.
Initially, actually, it slowed down the economy. But we made that sacrifice. And I think, in fact, I've been surprised how well we stuck to that target. Because in an emerging market, you feel sometimes these institutions don't get adhered to very closely. But broadly, if you see, while we have not hit 4 on an average for last 5-7 years, we have only 4.5, 5. But for emerging market to stay within 100 pips,
especially with that currency and that current account
and that
to stay
historical
with,
background where for 20-30 years you had probably 6-7% consumer inflation, right?
Sure.
So I think a lot of things are coming together.
Cool.
So I'm quite bullish on interest rate, but I can't predict next 6 months.
Obviously.
I mean,
No, but you said duration, that itself is a big call.
Yeah.
If you said that if you're going to play interest rates on the duration side.
The only thing why I don't invest more is being an equity guy. The payoff in fixed income doesn't look very attractive long term.
I thought you would say that it's diversification for you. Yeah, equity.
It is diversification, but given my conviction, I should put very big part. But then I feel that even if I go right, how much money will I make? Because equities, you hope that you will compound at 15-20%.
Yeah. And here you're getting like max 6, 7, 8% maybe.
Even get duration, you may make 9-10.
9-10%. Yeah.
But it's okay.
Maybe next time get Suyash on the show and we can get his view on that.
No, he's as big a bull.
Nice. Last question before we go into a break, Manish, is AI thing. It's still, how do you see this playing out on, the economy, on the market, on sectors?
Yeah, I should have said that apart from those two challenges which were internal, this is a challenge for India, but I don't know how it will play out.
And it's interesting that you're using the word challenge and not opportunity. Or do you think
it can be both, but see, one is you're reducing manual effort and India has a lot of people. So in one sense, it is a challenge. But the good part is, again, for the educated workforce, which can adapt to AI, because obviously if 100 units of manual effort are reduced to 50, but globally there's no supply of that 50 manual people, then we will get market share in manual effort. So we like GCCs, and we should actually benefit. But yes, it all depends on the pace at which. So if you listen to someone like Vinod Khosla, you would scared that even a radiologist will lose his job within 5 years and all that. But I think practically things don't happen so far.
Well, the reason why I'm asking you that, Manish, is the fact that the twin engines of employment in India, banking and IT, slowed. I mean, I don't hear that. Like 10 years ago, 20 years ago,
but again,
those are the
that's
two.
my point, that we think services is IT, but it's not. And of course, it's a bit of a challenge from the listed opportunity space that this GCC growth we can't play. In the listed
Okay,
space.
yeah.
But I'm saying what is happening today is a Japanese auto guy is doing EV product in Bangalore. US bank has 10,000 people in Bangalore, which we don't see from a listed perspective.
Right,
but that is what is driving service exports, right?
Very interesting.
So it's not pure IT. So the coding is obviously going to go down by 30, 40, 20%, whatever view, but it's going to go down, the effort, right? Which is going to hit pure IT services companies. But if someone wants to design, let's say Boeing wants to design a part, where will you get 100 aeronautical engineers in the world today, right? Apart from China, but
obviously
China's not.
China,
not a viable source right now.
Okay, so there is hope out there.
Yeah, I think, again, maybe I'm an optimist, but I think the pace of AI encroaching on jobs, if it's moderate, I think we'll be okay.
Cool. Folks, we're going to take a small break out here. On the other side, we'll be talking about equities. The thing that Manish handles at Bandhan. So don't go anywhere. We will be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
Welcome back. Manish, now coming back to equities. So, as someone who's been part of the mutual fund industry through a very interesting phase, right? Like, I'm assuming that when you started your career here, the SIP flows would have been zero. If not zero, then at least close to zero.
There were outflows for most of the time.
Yeah, thank you.
Interestingly, I started on the mutual fund space on the PMS side. And it was very dreary in the sense that I joined ICICI Prudential 2010 on the PMS side. And the hangover of GFC was so strong because in the GFC, a lot of the PMSs got hammered.
Yeah.
And, in 2010, in a PMS, to buy a mid or a small cap, you had to take so many approvals. Because today, you associate PMS AIF with mid and small cap. That time, people had become so risk averse that all the PMSs were also buying the top 50 stocks. That's it.
Hiding behind that, obviously.
Yeah, because of the history.
And now here we are in 2025 where it's a problem of...
It's like a 360 degree.
So where is the Indian household in terms of equity ownership? I'm asking this because I saw a very interesting interview that you had given that day about the breakdown of the Indian household balance sheet. I think you did real estate, you did gold. Just run our audience through that.
Yeah, so look, most families have 4 big assets to invest. Real estate, which roughly, as per a brokerage estimate, urban household value is about 500 lakh crores. Gold, which in last 1 year has shot up 50-60%, is today about 2.5 trillion, which is roughly 250 lakh crores. Bank FDs are about 150 lakh crores. Equities held directly and indirectly. What I mean to say, the retail holding as well as what you own through MFs and life insurance is about 100 lakh crores.
Wow.
So we're probably the only modern economy where gold holding is 2.5 times of equity holding, right? Because usually households don't have that much of gold nowadays.
And it's something that's not going to get liquidated. So
it is not, So I am hopeful when you see the split. Now, if you see 30-year returns, obviously equity is 14, 15. Everything else is 9, 10 broadly. If you see taxation, it is the most efficient in terms of taxes, and at least you hold for 2-3 years. It's not full tax, right? In terms of liquidity, that if I have 100 units, I can liquidate 20, which you can't do in real estate. So apart from returns, there's so many positives with equities that I'm hoping that means that we should have fairly strong flows into equities. Again, I'm not talking of 6-12 months. Obviously, they'll be up and down. And a lot of times when I say that, people say you're bullish on the market. I keep pointing them out. Liquidity doesn't change return on the market because ultimately it's driven by nominal GDP, corporate earnings, inflation plus 6%. But what it does, it smoothens out returns. That's all, right? I mean, maybe in this macro 10 years back, market would have fallen 20%.
Exactly.
Right?
People don't appreciate that as much.
But again, on the bounce back would have also come more violently in the last 10 years back. This time we'll not get that bounce back. Ultimately, interestingly, every market globally, in the long-term returns, inflation plus 5 to 7%. So it's got nothing to do with GDP growth. A lot of people, again, when they look at Indian equities and say, oh, you're growing 6-7%. Japan or US, which also grow less, if you see 10-20-year returns, they're typically inflation plus 5-6%.
Okay.
So is India, right? So, and I think that comes purely from demand supply, that if the returns are very high, people issue equity. If the returns are too low, they take debt and not issue equity. So it's kind of converges at that 5-6%. When I say domestic flows are likely to be strong, I'm not arguing that the market returns will change.
Yeah.
But what it will do is, just going back to the point we're discussing, that it will allow more entrepreneurs to come and list, because obviously supply will come. But I think it's good that a lot of these tech firms, a lot of these private equity firms make money, encourage entrepreneurship, good for the economy.
And that's how capital markets are supposed
Exactly.
to function.
Right. Yeah. So I do hope that this shift from physical assets to financial assets happens, although at this point, housewives are feeling very clever buying gold, which is done as well as equities. But I do think it's good for the economy if this happens.
This number, which is 25,000 crores per month, which is where it is now,
Yeah.
used to be 20 years ago. 20 years forward, where do you see this going? Like, is there a top? Is there a stabilization? How does this play out in developed economies, for example? Like, there's just this flow coming in the US, for example, it will come through a 401k plan, social security. In India, how do you see this shaping up?
I think a lot will depend on regulation, because if you think about it, in US, as we were discussing, there is no fresh supply of equities effectively. Then obviously the flows can be very high. I am hoping that, as I said, that what happens in private markets, part of it happens in listed, and we have maybe 10 years later, our default index will be Nifty 2000 rather than Nifty 500, which is the more default index today. And if the regulators encourage that, if we keep having this a bit of taxation advantage, if we keep investing in branding, promotion, etc., I do think that we will become a very, very big part of the funding ecosystem. And as I said, do what the private markets are doing globally. So yeah, I think it should go slightly faster than nominal GDP. If nominal is at 10-11%, this should keep growing 12-15% at least.
Okay, cool. Valuations on the index, I mean, we spoke about how you think that India should trade at a premium. You think just maybe you want to expand a little bit more for our audience?
So if you see last 20-30 years, we typically have traded 18 to 20 times 1 year forward. I would argue, and I might be wrong, but that's my bias, that because of this currency dynamic, because essentially at heart, what is equity valuation is discounted cash flow analysis, that you take 30-40 years of cash flow and discount it with the cost of equity. Now, what is that cost of equity? To my mind, cost of equity starts with US interest rates. You add rupee depreciation and you add company premium, right? Now, everything else being the same, the rupee depreciation was 4-5% earlier. Now you're arguing that it will be 2% or
Correct.
1 to 2%. If that is the case, then let's say for a HDFC Bank or Infosys 10 years back, if I was using 14% as cost of equity, I will argue that today you should use 11 or 12.
Makes sense.
And that theoretically leads to a 10 to 20% bump up in PE. So I will typically not become bearish on the market just because people argue last 10 year average PE is 19 and now it's 21. I don't find that a very worrying sign, let me put it that way. Of course, growth, if you say growth is lower next 10 years than last 10 years, that's a different, but then that is a stock selection issue also, right? But I do think that there is a theoretical basis to say that valuation should be higher.
Okay, cool. From that, if you just expand a little bit more on what you said about longer term equity returns being inflation plus whatever number
6%.
6%, because for a large part of our audience, when they go in and make their financial plans, people are also talking about long-term equity returns. Somehow when they say 15% guaranteed, I'm like, yaar, I don't know, मुझे समझ में नहीं आता ये. But if anything is out there that gives you 15% guaranteed year after year, तो थोड़ा तो issue है. So if you could just help our audience understand, like, first, when they're making a financial plan, what's a realistic equity return that you would plug into your overall asset allocation that would, that you think is a comfortable place to be?
So I think, to me, this is the best metric I found empirically, because if you read various kinds of data that has been analyzed, whether it's GDP growth, corporate earnings, interest rate, nothing really predicts equity returns. In fact, there is a professor in US called Siegel who's named this number 6.7 as Siegel constant. So apparently, if you take any 30, 40-year return of US market, it actually goes to this decimal place, 6.7%,
Okay.
which is uncanny. But let's take 5 to 7 as the average. And I think that it is behavioral. As
Okay.
I said, that typically what happens in any economy, the fixed income returns inflation plus 1 or 2% or 0 to 2% nowadays because central banks are very dovish.
Yeah.
So if equity starts returning inflation plus 10%, which was let's say 2024, then all the sellers of equity will supply,
Yeah.
right? So
Yeah.
Hyundai from somewhere in the world came and supplied
Did something
you
they did over
2-3
30
billion
years,
dollars.
yeah.
So the supply then kills the return, right? But if it goes to let's say inflation plus 3, then the entrepreneur will say that given equity is more precious to me, then why will I not raise debt and manage with debt, right? So I think it is when you think about it from that perspective, it's very intuitive, right?
Yeah.
So if you see today, Nifty 500 real return on 10-year basis exactly more or less 6.2, 6.3%,
Okay.
which is the framework I used to say that it's a fair value market. In October or November, it was 8-9%, which is a bit concerning. Although historically, let's say in I think 2007, which is the classic top, I think it was some 20% real
Wow.
return. So you could have sold it just looking at this metric.
Nifty 500 10-year, I'm assuming rolling return at the top in 2007
like
was
15-20%.
15 to 20%.
Yeah, because
And-
the index was up 6x, no, from
Yeah,
2002 to
And most recently in 2024 also it was, you said about?
9-10%.
Yeah. And the Nifty 500 is
But it
as
converts to 6% because
Yeah.
with time and this correction.
I'm just saying that the Nifty 500 is as good and as accurate a measure of India's equity returns related to the stock market.
Yeah, I think it's
much broader
it's like
than the Nifty
60-65%
okay.
large cap, 25-30% mid and small.
Yeah.
I think a fair index.
So that's a great benchmark, right? If you're
Yeah.
saying that our inflation is going to be like 4-ish%, whatever
Yeah.
is the...
And yeah, that is the other point that people look at that 1990 to 2020 at 14-15. I don't think we should expect
Yeah,
that,
that
right?
era is
Because
over.
inflation was
Was also-
7% there, right?
And interest rates are also...
Correct.
Yeah.
So now I think nominal GDP is likely to be 10-11%.
Yeah.
So inflation is 4-5. So 4-5 plus 6, 11 is what we should expect. Maybe the small cap index can outperform a bit, 1 or 2%.
Yeah.
But where I am very ambitious, if you can use that word, I think a good small cap fund can do somewhere between 15-20%, which is a
Wow.
great asset to own.
Yeah.
So
Long term, like really sticking to it and...
will be volatile,
Yeah,
of course.
yeah.
But I think the choice is so high. A good research team, good execution on fund management can give you good alpha, and the index itself may do okay. So I think hopefully a good small cap fund should do
Yeah.
more than 15.
It's a nice way of looking at saying that if this is, the risk, I don't want to say risk-free and equity in the same sentence.
Yeah.
But if you're saying if broad-based equity at an index level can give you 10 to 11%, then the
Yeah.
well-chosen small cap fund, which is well managed, there is enough room in India for that to give you a reasonably good alpha if you stay with it for the longer term, if I've understood you
Yeah.
correctly.
Also in the context, what is happening in India? As I said, we are developing in capital markets a bit differently from the Western world,
Yeah.
where somehow maybe it's because of historic returns or taxation or culture, companies want to get listed. And that is a good thing for us at least.
I mean, we've spoken about this, but anyway, your view on FII flows versus domestic flows. FIIs, because of geopolitics, if they exit, then that could cause some problems. But you think that this equation of FII and domestic has had an impact on the market, whether it's in terms of valuations or in terms of stability?
That's
or
what I
it's still-
say, that liquidity doesn't really change return. It will finally be inflation plus 6%.
Okay.
But it's good to have heterogeneous views. So it's good to have sometimes FI buying like they're doing now and sometimes DI buying, which was last year. Reduces volatility. That's the only advantage you get. And to a certain extent, I think it makes the case a bit more stronger for small cap. Because see, historically, and you will remember this, that any fall in the market, small caps used to get hammered, not necessarily because of fundamental, even the good small caps, because of the liquidity crunch.
Liquidity, correct, yeah.
So if you have better liquidity, I think the in a way, the cost of equity of owning a small cap goes down. Not because the earnings will be anything different. Obviously, earnings will not be different, but the volatility will come down.
Okay, we are done. I would have asked for a wrap on the specific points that you said, but you've been so clear, in your recommendations that one is that, a small cap fund chosen well, that makes sense. The sectors you've already given, export facing. So I just want to wind up this episode with two standard questions that we have for all our guests out here. One is what I call a career corner.
Okay.
So what are the careers that the AMC industry has to offer today? And what are the qualities that you look for when you interview candidates?
So AMC is a mix of FMCG and investment bank. So we have a very plethora of roles, right? Because it's also a sales and branding institution, but we also obviously at core are an investment institution. So it's actually a very good mix. So we have the big functions are sales, risk, ops, investment.
Sure.
You need different kinds of people for this. On the investment side, because I come from that side, so
let's talk about
I can
that,
only talk about that. We obviously look for people with passion because ours is a bit like sports, right? It has positives and negatives, but it's so competitive finally that unless you live and breathe this profession, you are unlikely to excel. We like people who are entrepreneurial in the sense that, look, I've seen, and you will obviously kind of agree with this, that you can create alpha in multiple ways.
Obviously.
There are people who are good at reading management. There are people who are good at desk research. There are people who hit the ground and do channel checks and get information. So we don't really bother about what is your style. We let a person be, because we generally also recruit fairly experienced people. So we don't recruit freshers usually. So our philosophy is that just like when you recruit a batsman for a test team, at that stage you don't go and say play a cover drive this way, your knee is not planting well on the pitch or something like that, right? Because obviously that person's supposed to have sorted all of this and then come to the you're crease. More in the mentoring kind of thing, that the organization should have a very performance centric culture, very objective, a very good place to work at. It's like the nets. You can only give a good nets practice and hope that that person can go and score runs.
Obviously.
So we look at outcome-oriented people who are entrepreneurial, who are passionate, and obviously in our business a bit of numerical and analytical skills are required. But as I said, when you recruit experienced people, you're assuming that is hygiene.
Sure. 70, 80 hours, 90 hours a week. I don't want to talk about that. I'm not looking for a comment from you from that, but I don't know why people obsess about that number. I just feel that if you're passionate about the job,
exactly. I mean,
see,
again, I'm not very fixated about people spending too much time in office, because you can be at home and still be thinking about a stock you bought or sold, right? I mean, so there's no point confining yourself into these hours of work.
But at least the basic thing is passion. You should at least have a thing for stocks, for the stock market, for investments, for alpha, for understanding. That all is to taken for granted.
The most important thing to my mind.
Folks, hear it from someone who does this, who's been doing it for a living. And our standard question: any book that you're reading that you'd like to share? Any recommendations or anything in?
Yeah, I read a lot of different types. So right now I'm reading this history book, The Golden Road by William Dalrymple.
Okay.
Just started. But one interesting book I read last year was this Andre Agassi's biography, Open.
Oh, wow.
I think it's
awesome.
It is a very good book. I mean, and maybe because I like sports, it's good to relate. But it relates to investment if you think of it from that perspective.
Brutally honest.
About the passion, about what you need to sacrifice.
And the challenges that he faced.
The medical issues, what all you need to do to keep your body fit.
And to imagine that guy's into pickleball now.
Yeah.
Crazy. Folks, there you go. The Golden Road and Open, two great book recommendations. And that's it. That is a wrap on this episode of Paisa Vaisa. My guest, Manish Gunwani, Head Equity at Bandhan AMC. Manish, thank you so much for doing this for our audience.
Thanks a lot. Lovely being here.
Thank you.